Module 9. Debt and amortization. Capital leases. A capital lease is a type of lease in which the lessee, the person or company leasing the asset, treats the leased asset as if they owned it for accounting purposes. In other words, the lessee recognizes the leased asset as a long-term liability and records it on their balance sheet. Under a capital lease, the lessee is responsible for maintaining and insuring the asset and paying for any required repairs or maintenance. Additionally, the lessee can purchase the asset at the end of the lease term for a predetermined amount, typically the asset's fair market value. Capital leases are typically used for assets with a long useful life and are expected to be used by the lessee for most of the asset's useful life. Examples of assets often leased under a capital lease include real estate, heavy equipment, and vehicles. It is important to note that capital leases differ from operating leases, in which the lessor, the person or company that owns the asset, retains ownership. The lessee treats lease payments as rental expenses. The lessee records the leased item as its asset for a capital lease. For an operating lease, the lessee reports the lease payments as rental expenses. For a capital lease, the lessee depreciates the asset acquired under the lease, but for an operating lease, the lessee does not. Capital leases create a long-term liability on the balance sheet, but operating leases do not. Debt-to-equity ratio. The debt-to-equity, or D/E, ratio is a financial ratio that measures the relationship between a company's total liabilities, i.e., its debt, and its shareholder equity. It is a commonly used metric for assessing a company's financial leverage or ability to meet its financial obligations. To calculate the D/E ratio, divide a company's total liabilities by its shareholder equity. The resulting ratio represents the company's debt for every dollar of equity. For example, if a company has total liabilities of $500,000 and shareholder equity of $250,000, its debt-to-equity ratio would be 2-to-1, i.e., $500,000 divided by $250,000, which is, of course, 2. A high debt-to-equity ratio suggests that a company has a significant amount of debt relative to its equity, which may indicate that it is highly leveraged and may be at risk of defaulting on its debt obligations. On the other hand, a low D/E ratio indicates that a company has a relatively low amount of debt compared to its equity, suggesting that it has a solid financial position. It is important to note that different industries may have different levels of acceptable debt-to-equity ratios based on their unique financial characteristics and risk profiles. Therefore, comparing a company's debt-to-equity ratio to other companies within its industry or to industry benchmarks is essential to assess its financial leverage more accurately. Amortizing a bond discount. When a bond is issued at a discount, which means that the bond's face value is less than its selling price, the discount represents the difference between the face value of the bond and the amount the issuer received when the bond was sold. The discount is amortized, which means gradually reduced, over the bond's life, typically using the effective interest method. Amortizing the bond discount involves allocating a portion of the total discount to interest expense each interest period. This reduces the interest expense recognized on the bond each period because the amortized discount is added to the bond's carrying value, which is used to calculate interest expense. For example, suppose a company issues a $1,000 bond with a 10% coupon rate when the market interest rate is 12%. In that case, the bond will be issued at a discount of $81.42, calculated as the difference between the face value of the bond and the present value of the bond's future cash flows at a discount rate of 12%. The discount is then amortized over the bond's life, typically by recording an adjusting entry at each interest payment date. Amortizing the bond discount does not affect the bond's payable account, the market value of the bonds payable, or cash flows from the bond. Interest payments due with annual installments. Interest payments due with annual installments refer to the amount of money that a borrower owes to a lender each year for the use of borrowed funds. When a borrower takes out a loan, they must pay interest on the principal amount borrowed, which is the amount of money they received from the lender. In the case of annual installments, the borrower must make regular payments to the lender each year, typically on the anniversary of the loan. These payments are made up of both principal and interest, with the interest portion being calculated based on the outstanding balance of the loan. For example, suppose a borrower takes out a $10,000 loan with an interest rate of 5% and agrees to repay it over 5 years with annual installments. In this case, the borrower would need to make annual payments of $2,325.77, which includes both principal and interest payments. The interest payment for the first year would be $500, 5% of $10,000, and this amount would decrease each year as the outstanding balance of the loan is reduced. It's important to note that the interest rate, loan term, and payment schedule can all impact the amount of interest payments due with annual installments. Additionally, if the borrower fails to make a payment, they may be subject to late fees and other penalties. Cash flows from investing. Cash flows from investing is a section in the statement of cash flows that reports the cash inflows and outflows related to purchasing and selling long-term assets, investments, and other investments not considered cash equivalents. Examples of cash inflows from investing activities include proceeds from the sale of property, plant, and equipment, proceeds from the sale of investments in securities, and cash collected from loans made to other entities. On the other hand, examples of cash outflows from investing activities include purchasing property, plant, and equipment, purchasing investments in securities, and lending to other entities. The net cash inflow or outflow from the investing activities section reflects the amount of cash generated or used by the company for investments in its long-term growth and strategic initiatives. It helps stakeholders understand the company's investment strategy and how it is financing its capital expenditures.